You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
Welcome back to Options Insider Radio, the program where we bring on guests from throughout the world of options and proceed to pick their brains for the benefits of you, the listener. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-expanding Options Insider Radio Network. And our next guest here, coming up from the OIC 2014 conference, is an old friend of the show, even though he hasn't been on in a while. He is Andy Nybo, the head of derivatives research over there at TABB Group. Andy, welcome back to the program.
Good morning, Mark, and thanks once again for having me. Yeah, it has been a long time, and I'm excited to be here. Thanks for having me.
It's been quite a while, so why don't you go ahead and give our listeners, obviously a lot of new people have tuned in since the last time you were on, go ahead and give them a bit of an overview of your background in the space and what it is you do over there at TABB Group.
Sure, thanks. Well, TABB Group is first and foremost a research and consulting firm, and we focus really on trading technology in the front office, middle office, and back office, and how it impacts market structure, and how market participants really act in the capital markets. I currently I run a derivatives practice, and I spend 90% of my time thinking about options market structure and coordinating our research efforts around those topics.
Well, I know you have a lot of interesting research coming out these days. Most recently, you put out an interesting study looking at some of the European demand for options. Why don't you give our listeners a breakdown of some of the salient points you found when doing that research?
Sure. So we've been working with the OIC, Options Industry Council, for a number of years now. And one of the things they asked us to look at back in 2011 was the rising demand, the demand coming out of Europe for U.S.-listed options products. And so we went out and we interviewed 25, 30 different individuals at firms active in the options industry and kind of got inside their heads about why European investors were using options in their strategies. We talked to sell-side firms, buy-side firms, technology vendors, and we found that there was a lot of demand for U.S. listed options products. So that was 2011. We worked with OIC again most recently in the first quarter of this year, looking at the current environment, for demand for U.S. listed options. And we found there's still consistent demand for U.S. options for a number of reasons. Number one, deep liquidity, deep transparency is also a factor they look at, and access to the markets. They can get size done, they can affect their strategies, support their equity strategies, and hedge their portfolios in times of market stress. We estimate currently about 9% of total U.S. options volume is traded by investors and participants domiciled in European countries.
Obviously, there's the big products that list here, SPX, SPY, things like that. Is that where the bulk of their activity is, or what products are seeing the biggest demand over there from the European clientele?
Sure. So again, this is we're looking back a couple of years, and when we first started doing this study back in 2011, you kind of remember that the economy, the marketplaces were in flux. There's a lot of volatility around the downgrade of the U.S. federal government, for example, in the summer of 2011. Just like U.S. investors or other international investors, Europeans were looking at ways to hedge their macro exposures. So there was a lot of interest in SPX, SPY options to manage those exposures. Fast forward 3 years, there's still interest in using U.S. listed options for hedging purposes. But what we found is there's significantly rising demand for ETF products, as well as a number of index products. When we were doing the study, there was emerging market volatility. China was lowering their growth estimates, and there was a little bit of an emerging market meltdown. What we saw and what was reported by the dealers during that time period was huge demand for ETF options that allowed them to hedge their big, broad exposures to emerging market economies. So the EEM ETF option saw huge trading in January, February this year, as well as rising trading volume last year.
And you mentioned hedging activity. That's the primary use case, or are you seeing a lot of other things? You're seeing the typical use case for institutionals, covered calls and overlays and collars and things like that?
Sure. So it's similar to what U.S. institutional investors are using options for. So premium generating strategies is one of the biggest things that they use listed options for. But what we've seen is that rising demand to use U.S. listed options to hedge their portfolios. So hedging has become a bigger part of what they do, not only using ETFs, individual stocks to some extent, although that's still a small proportion of their activity, but also rising interest in volatility products. So the VIX options from SIBO, the VXX IPAP Barclays volatility options, huge demand for anything volatility coming out of Europe.
That seems to be the case across the board. U.S., overseas, everyone just can't get enough VIX these days. I don't know what it is. It's the lightning in a bottle of the options world these days. Speaking of the options world, one of the reasons you're here at the conference is to give your, I guess, annual now State of the Union, State of the Industry type address. We're looking at a lot of the different data you guys have pulled from the options market over the previous year. Why don't you go ahead and give our listeners a little bit of a sneak preview of what you're going to be talking about tomorrow?
So, absolutely. So one of the things that I think the industry is excited about is we're starting to see a little bit more trading volume. Volumes are rising this year. We're up about 7% year over year in terms of Q1 2013 to first quarter 2014. So I think that bodes well for the industry. The factors behind that are a somewhat muted uptick in volatility in the first quarter. We're up higher over 2013 levels for the first quarter, but still lower than 2012. With that said, we see rising volumes. Again, I mentioned the ETF volumes coming out of Europe, very popular here in the States as well. Same strategies, more macro exposure, hedging exposure activity in those ETF options. We're also seeing rising demand for the retail investor over the past several years. So now we estimate about 24% of total activity in options, U.S. listed options, comes out of the retail sector, and that's up a percent or so from the levels we saw in 2012 and into 2013.
One of the big stories coming out of this conference a couple of years ago was the mini options. Speaking of the retail consumer, the retail end user for the product, they were going to be the panacea for all the ills of the retail options market. They're going to help people who had odd lots of Apple be able to write covered calls and buy puts and things like that. Fast forward 2 years, and they've been listed for about a year and haven't really lit up the tape. The volume is pretty anemic. I think somewhere around 11,000 contracts a day, which divide that by 10, it's 1,100 contracts a day. Not exactly lighting up the tape. That's across all the minis, all 5 classes. So not exactly a lot of numbers. Has any of your research gone back into that space? I know you do a lot with looking at retail these days and their adoption of products and maybe why they haven't rushed to embrace the minis yet, like a lot of people thought they might.
Yeah, I mean, I was one of the believers last year, and in my remarks at the OIC in Vegas was that the mini options offered a lot of potential for the retail customer base. I think that part of the reason we haven't seen as much volume is because of, again, the story that needed to be told around many options. When you start trying to describe how they're different and how they're traded, and it's a different increment, and you get, if you're a retail options trader, you pull up a screen and there's 2 different screens, and it's a split screen, and one is 1/10 the option. Any layer of complexity tends to make investors take a pause and step back a little bit. I also don't think that there was significant marketing efforts put on the minis specifically. And as you know, Mark, any new product launch requires significant effort to explain, expand, and to identify why the investor should be using these products. So although there are attempts to be made, not a huge industry effort wasn't targeted at the mini options. So that's been one of the challenges with mini options. And you know, the recent Apple announcement of a reverse or the split they're going to be doing, I think is you know, telling in that you know, market valuations, the price of some of these the prices of these higher priced stocks have gotten very high. So I think you'll start seeing maybe some follow-on effect with Apple's experience of their announcement, the rally in their shares that is partially attributed to that. I think other high-priced stocks firms will start looking at that.
That's why a lot of the conversation has come back to the minis again, is in light of that announcement from Apple. A lot of people are saying, well, that kind of obviates the need for a product like this. So a product that already hasn't really caught fire over the past year for a lot of the reasons you mentioned, as well as full freight commissions, markets that are absurdly wide for a very, very low value type contract. A lot of things kind of conspiring against this product, it seems like, and now maybe Apple may have finally put the nail in the coffin. I suppose we'll see afterwards if other products like Google and things could pick up the slack a bit, but so far that doesn't appear to be the case. You focus on market structure a lot, like you said, over there, Andy. It's been a pretty hot area of late, thanks to Michael Lewis and his pretty weighty tome there, Flash Boys, where he gets into a lot of the HFT and its impact, primarily on the cash equities, but a lot of that filters into the options world. Again, there are a lot of options firms named in that book, and there's a lot of that can be carried over into the options space. I'd imagine you read that book with a lot of interest. What's your take on Flash Boys and the resulting furor that has erupted post-release of that book?
Sure. So anytime you get the marketing prowess of a book publisher behind a book, an author with the name of Michael Lewis and what he's done in the past, and you know, an appearance on 60 Minutes to boot, where he is able to present a one-sided argument about market structure and you know, make some pretty aggressive statements about how the market is rigged for the retail investor, you're going to get media attention, particularly when there is a tone from Washington blame, you know, Wall Street for all the economic problems that we've seen over the past 6 years since the crisis of 2008. So I think the media kind of jumping on top of the story and kind of getting into the details around the book kind of abated somewhat when they started to dig a little bit further. Yes, there is a lot of high frequency trading equity markets, and market structure needs to be examined. But I don't think that the market is rigged. I don't think the market is broken. I think the market has adapted to the regulatory environment. You know, what I see coming out of the furor around Flash Boys is an examination of market structure and how it needs to be examined and perhaps tweaked after Reg NMS to make sure that it creates a fair and equitable market structure. You know, the retail investor has never had it so good, in my mind, whether that be in cash equities or in the options markets. You know, the focus of the book was on equity markets and failings perhaps in some of the market structure components of equity markets. But there will be a spillover effect on related markets, listed options, listed futures. But again, I don't think that some of the claims made in the book really are accurate in the options market. Or in the futures market. I believe that you know, a lot of the activity, a lot of the automated trading that occurs in the derivatives markets is due to the complexity of the markets and the need to kind of manage risk exposures for market makers and those that do provide liquidity in the marketplace.
They make a lot of interesting claims in the book. Some of them have merit, I think some of them less so. I've been a little surprised to see so much of the focus post-release being on exactly what you said, the notion of the markets are rigged. I mean, it's a catchy line, I get that. But I think reading the book and looking at the different cases he puts forward in the book, that's probably the least arguable case that you can make from that book. I mean, if you want to go out and argue that the size guys, the 10,000 up options guys and the million plus share equity guys are being disenfranchised by this activity because the liquidity is fragmented, I think you can make a case for that. If you want to make some of the other arguments about conflict of interest at the exchanges. I think there's some interesting points there, and yet it's kind of all been washed away by this mantra that the markets are somehow rigged against the little 100 share retail trader, which I think is demonstrably false. I mean, look at the markets and how exactly what you said, how tight they are. The commissions have come down. All of that has benefited the end retail trader. So it's kind of odd to see some of the more interesting points get washed away in this tsunami of hype around a point that doesn't really seem to have any legs behind it. And yet people like Charles Schwab, who probably should know a little better, maybe jumping into the fray and inserting himself into, and other big firms doing the same thing. It's been interesting to watch the reaction after this release and seeing what people are grabbing onto. Just the other day, Chairwoman of the SEC came out and had to address that again, saying the markets aren't rigged. It's become this odd catch line, which takes away, I think, from some of the other good points he actually makes in the book, which maybe that's your takeaway as well. I don't know, but it's interesting to me to watch, like I said, people kind of grasping on, I think, the wrong thing. We did launch a new technology program on the network a few months ago, and we recently had Blair Hull on, who was receiving the Sullivan Award here this year at the conference. And he made some interesting suggestions about what he thought should be done about HFT, including adding a minimum order life to every order, so they have to exist for 200 nanoseconds or whatever the case may be, whatever arbitrary number they decide upon. And the other was having a cancel fee. Either one of those, or the two in conjunction, really would seem to be able to put a stop to this, if that's the goal, to put a stop to this type of activity, whether it's the latency arb or whatever type of activity you're talking about. I think it'd be interesting to put that in place on maybe a small number of names just to see, because there's so much vitriolic statements on this on both sides. I think as a data guy, probably would love to see more hard data. I think it would be very interesting to see if they just did a little test on a few names, what the impact would be. If these HFT guys have to pull out because they're getting charged cancel fees, if as a result the market's widened out and then therefore the retail guys are disenfranchised by that, those are clear and demonstrable costs there, or maybe the markets stay tight. It'd be interesting to see some actual data come out of something like that. Have you heard any proposals like that, and what's your take on those type of suggestions?
No, I haven't heard any formal proposals coming out of the regulators or out of Washington. I think that given the level of public attention to this, there probably would be some sort of pilot program proposed. But getting we as an industry or as we fall into this labeling of HFT activity, and I'm not sure that anybody really knows what an HFT firm is doing, or what it really characterizes an HFT firm, and it's become this label that seems to imply bad behavior by a firm. HFT trading is a bunch of different things. Market making is part of the framework of the options industry. If you don't have market makers that are able to get in and get out, post their quotes, manage their risk as fast as they possibly can, how can they participate in the market in the same way they do now? They're going to widen out quotes. They're going to pull back. They're going to decrease the amount of liquidity made to the marketplace or provided to the marketplace. So I think an idea that there's a minimum quote time enforced, there's a cancel fee. Will that apply to all market players? Will it apply to market makers? Will it apply to low latency players in the marketplace? I think that needs to be explored a little bit more. But to force a market maker to so-called, catch a falling knife in times of market stress, that's why they spend millions of dollars a year on the system to manage their risk exposure in the marketplace. 12 options exchanges, fragmented market structure. They have to be everywhere they can be to be able to trade against the order flow. To tell them that, well, you're going to have to stay in the market for X amount of time and you're going to get charged an additional fee to cancel, that's going to disincent market makers from providing additional liquidity, widen out spreads, and impact trading volumes.
Yeah, I think of those two, I think the minimum order life probably has the least legs. I think the cancel fee might have a little bit more momentum in the marketplace. Of course, we'll have to wait and see what all the results of this tsunami. One thing we've learned whenever there's a lot of regulatory heat and media heat on something is that usually the initial blush, the initial regulations always have interesting unintended consequences. So it'll be interesting to see what results after all of this flash boys and what else we have to deal with coming down the road as a result. A lot of people have argued, and perhaps successfully, that what we have now with HFT is an end result of what happened to Reg NMS a few years ago and some of the unintended consequences of that. So now we have perhaps new regulation coming down the pike. We'll see what happens with that. I want to hit on something else you just mentioned, which I think is right up your area, and I think is interesting to a lot of our listeners as well, is, of course, the market fragmentation. It's always a hot topic here at the conference. How many exchanges are too many, et cetera, et cetera. It's always on the leaders panel, and every year it's a hot topic. Since the last time you've been on the show, particularly over the last year, 2013 into early 2014, we saw a lot of technology failures, pretty high-profile ones in the options market in particular. They were usually the domain of other markets, equities, and et cetera. But last year, we really saw a lot focused on options. We saw Opera go down. We saw a lot of the large liquidity providers have some issues and just other issues across the board. And a lot of people start to point the finger back to this Byzantine structure that has emerged, I think for lack of a better word, in the options world, 12 coming on 13 exchanges, just having to connect to all these different exchanges with different rule sets, different technology sets, different fee structures. It's a lot. It's adding a lot of complexity to an already complex situation, which would then lead to perhaps these failures happening at a larger rate. What's your take on the net impact here of this fragmentation feeding back into the marketplace? Do you think it's adding more risk and more complexity to the marketplace, or are the benefits of competition outweighing the demonstrable increases in complexity and cost and risk that we're seeing out there these days?
Well, that's a multifaceted question, but I believe that it's all related. Obviously, you can't have complexity in today's day and age without having a high degree of dependence on technology. Whether that's good or bad, well, it's always bad when something breaks. But when you're looking to get a big trade-off and you can access liquidity across multiple exchanges and get very tight spreads and get efficient execution, well, then it's great. It's fantastic. So, yes, we do depend on technology more and more in options markets. You look at the options market-making firms today, almost 97% of their order flows is executed through an automated fashion. So technology supports the growth in this industry. 12 different exchanges, they're all competing for order flow. So what does that do? That causes fees to go down. It results in innovation in the types of products that can be traded on an exchange. The types of execution that can be completed on exchange, price improvement auctions, the ability to do complex orders, synthetic complex orders. It's all very complex, but at the end of the day, I believe it brings a lot of capabilities to the industry. It provides the end users, the investors, with access to ever more attractive product sets and ways to trade, and it really does lower the cost for the industry. It's unfortunate when technology breaks, but guess what? Technology breaks. That's why there's repair shops. That's why planes get taken down for maintenance, and your car gets in the auto shop every month. Hopefully not, but periodically. So what we need to do is ensure that we have resiliency in the system. And that we can recover when there is a technology failure. Does that mean a backup for every system out there? No, it's just impossible. It's too expensive to support that kind of framework. But should there be a set of protocols, a set of consistent rules that are applied when there is a technology failure, whether it's big or large? Absolutely. And once you have the ground rules in place, once you have protocols that you're going to react to when there's some sort of system hiccup or failure, then you recover that much more quicker and get back to the day-to-day business of trading options.
When you're talking to a lot of these institutional end users, the clients, the customers for your various research and studies over there at TABB, what's their feedback about the fragmentation of the options market? Do you find that they generally view it as a positive for all the reasons you just described, that they can execute across multiple venues and have competition keep costs low, or do they view it as a negative because it's a burden to execute across multiple venues and the costs associated with interacting with all those venues is high and it also fragments the liquidity? What would you say is their net viewpoint on that from your perspective?
Sure. So if you look at, I guess you have to segment the industry. So if you look at the end user, the investors, the institutions, the hedge funds, the asset managers, the retail accounts that trade options and use options as part of their strategies, frankly, they have no idea how complex the markets are. All they know is they get executed, they get a price, they get done. They know what their fees are, the commissions they pay, and they know the performance of their portfolio. The burden of managing the complexity, the burden of managing the fee structures, all the different trading protocols falls on the sell side, the brokerage community. So if anybody's pulling their hair out, it's a brokerage community that has to support access to the exchanges, support best X, and routing the orders to the correct venue and getting the best execution for their client base. So they are the ones that are most directly impacted due to the complexity of the system. But again, it provides an opportunity for firms to step up and provide a competitive advantage to their customers and provide better service to their customers. You know, one thing that we lose track of is on the institutional side of the business, not all trading is electronic. A lot of it's done over the phone. You know, upwards of 60% of order flow from institutions is executed over the phone or through a fixed message to their broker and a conversation associated with that. So it's still a very much voice broker market, particularly for those bigger trades that need capital, that need facilitation, that need to be you know, managed and worked by the broker.
Yeah, it's true. Look at products like SPX and their thriving nature. That still is a predominantly pit traded product, and you need a lot of high touch execution to get that done. Interesting viewpoint then from the end user. So they're not complaining then about, let's say, having to execute a spread across multiple exchanges, and one venue has a spread book with one leg and one venue has a spread book with the other leg, and never the twain shall meet, and so they can't get the spread off at the MBBO. Nothing like that. It's really, they see it more as a net positive at the end of the day.
Well, I mean, one way to look at it is it depends on how complex a spread is and what type of account is trading that spread, right? So if it's, you know, complexity is supported by technology, but complexity can also be supported by a execution consultant, a voice trader that's really good at what he does. So, you know, you will get institutions that are doing significant size, picking up the phone and working with their broker to get that complex multi-legged trade done. You'll get other institutions that'll, you know, try to do it electronically, execute it electronically, and it gets routed into a smart order router and gets parsed out and executed that way. So it's again, it's somewhat transparent to the end user. All they know is they click go or send or execute, and the smart order router, supported by their broker or their vendor, is where all the hard work and the details are taken care of. But in terms of market structure, if you ask a buy-side account how many exchanges there are in the options world, inevitably they will say 4 or 5. They have no idea there's 12 different exchanges out there. So it is absolutely something that is that's not top of mind. All they know is they want to get their execution done, they want to get it done at a good price, and they want to get away to the next trade.
I suppose that's a good thing at the end of the day. The less they know sometimes, perhaps the better. You don't want to see how the sausage is made. You just want it to be tasty and delicious at the end of the day. Well, Andy, I know you have a lot of different research you're working on over there. Before you go, give our listeners a little bit of a taste, a little bit of a sneak peek about what's coming down the pike from TABB from an options research perspective.
Sure. So we actually have a new series of reports coming out next week. It's going to be a kind of a broad overview of the options market. It's a data-intensive report that looks at things like spreads, looks at volumes, ETF volumes, index volumes, trading by name, quarter over quarter. That will be a new quarterly report that we'll be publishing. It's almost like a state of the industry on a quarterly basis for options, as we're also doing a report on listed futures similar to that. In the next month or so, we will be starting up our annual buy-side options trading study. Go out and talk to 50, 60 different buy-side traders about how they use and execute options in their strategies. Matt Simon, my associate, is finishing up his interviews for our index-based study on listed futures, so how the buy side uses listed futures in their trading activity, the brokers they use, how they execute, again, very similar to our annual option study. We're trying to get inside the buy side trader's head on how he executes futures and why he chooses the products he chooses. So those are two of the larger studies we're doing. We also have some work in the some research around options TCA, transaction cost analysis, that we're just starting to kick off. We're going to be revisiting the options EMS world, execution management system world, looking at what's changed in that space over the past year or two, and how firms are providing the tools that their clients are asking for to help manage this increasingly complex marketplace, as we talked about earlier.
TCA certainly seems to be a growing aspect of the industry as well, with all this fragmentation and typed spreads and different products. People want to see their net impact whenever they make a trade, and they want to try to perfect that whenever possible. So I think a very interesting area for you guys to dive into. Well, Andy, this is interesting stuff. I'm glad we could have you on the show. We have to do it more often than once every 2 or 3 years, whatever it's been since your last appearance. And before you go, if our listeners want to learn more about what you're working on and what you guys have coming down the pike over there at TABB Group, where should they go?
Feel free to send me an email, anybo@tabbgroup.com. They can go to our website, tabbgroup.com, and take a look at what we have in the pipeline and on the existing agenda. I also will ask your listeners also to take a look at tabforum.com, which is our what we like to call our capital markets blog, and they can get access to a lot of information out there submitted by the readers and participants in that website. 20,000 registered users on that platform. So it is a must-look-at site for a lot of your listeners.
I think calling it a blog does it a disservice, Andrew. It's pejorative these days. There's so much content on there. It's much more than a blog, the TABB Forum. All right, Andy, thanks for coming on. We'll have to bring you back on again down the road.
Absolutely. Thanks very much. Appreciate it.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions@theoptionsinsider.com.